All right, so with that in mind, now this presentation, the second module we can discuss, Maureen, we can use a case study of your current property within your own portal. As a matter of fact, in Tuscaloosa, Alabama, this property is $230,000. Now, let me tell you, now on the face value, when you look at the numbers, as a recent investor, especially newbies out there, you're thinking, oh, this is not going to meet my expectation. Hold your thought. Experienced investors, I think you know what I'm going to talk about. And Maureen just went through over that. There are more than one way. Creating wealth through real estate is not only about cash flow or lack of it. Now, the face value of this great value new construction home in Tuscaloosa, Alabama is still on the portal, Maureen. I'm using this as an example. I know this is an example of a $230,000 new build single family home in Tuscaloosa, Alabama. We can make the argument, what I'm about to show you, the numbers I'm about to show you does not, don't worry about the 230K. I could talk about the presentation as if this is a $100,000 property or $150,000 property or $275,000 or even $350,000 property. The concept is the same, all right? What I'm about to explain to you applies to cash flow properties within this price range. So even though I decided to choose this $230,000 property as a case study, right? Now, you look at it, briefly look at the numbers. Purchase price $230K, very good new build. New. It's such a. We're not gonna spend too much time on a new build. There's so much value a new build has on other, older properties. Even though the older properties is just as good if it has been, renovated properly and make it in a turnkey status like the one Spartan Invest has been promoting. In addition, the resales, the older resales, and the new builds that Spartan Invest has is just amazing. So you look at numbers, initially you're thinking, okay, I'm putting 25% down payment. I'm paying almost 6% interest rate or 5.5% interest rate on this. My total out of pocket is $61,000. Okay, that's fine. And then you look at the monthly rent. So I'm only getting around $1,300 monthly gross rent to buy a $230,000 property. I mean, this is not a good deal. Hold your thought, Maureen, right? Many investors, especially the newbies out there, you look at the pro forma of a first year projection. I know pro forma is just, I know it's an initial evaluation of a property, but it's way beyond the first year projection. Okay, with that said, let's talk about first year projection. Even at this $1,300 monthly rent, which by the way, I'm sure Maureen gonna say, oh, this $1,300 is a very conservative figure, and the rent will increase based on what I just said, right, about what's going on with the rental increases and what have you. So it's gonna be a much higher than $1,300 down the road, right? But this is just just a projection, and then you're thinking, wow, the rent to value ratio really does not make sense. The cap rate is only like 5%. It doesn't make sense. Hold your thought, okay? Just be patient what I'm about to say. Now, in this particular market in Alabama, look at the property tax rate on an annual basis. $1,100 annual property taxes. That's like half. What is it? That's like less than half of 1% property tax rate. If you buy a property in Texas, for example, the property tax rate could be as high as 3% of the purchase price. Think about that. In Alabama, your property tax rate is half of 1%. This is shockingly impressive, Maureen. I don't know why Alabama, the property tax rate is so low. That's why this projection, this property evaluation based on a savvy investor like myself and you, Maureen, it still makes sense. Hold your thought, right? So it creates better cash flow because the property tax rate is so low. Briefly, Maureen, can you share with the audience why the property tax rate in Alabama is so low?
Yeah, it's very easy. So every state they have to fund the police, fund their schools, fund the infrastructure, right? So they find a variety of ways to tax us citizens living in that particular state to attract, get those revenues to maintain the state as they need to. So the beautiful thing about Alabama is they get the majority of their tax revenue from sales tax. So, it's like, you can look at you can break down all these different states. Some have very low property taxes, some have very high property taxes, but the high property taxes might have low sales tax, right? So with Alabama, we just benefit because they get the state gets the majority of their tax revenue from sales tax and income tax, right? So we benefit just from the low property taxes. They haven't changed that, so that's what makes it work so well.
Yep, I agree. All right, so let me continue. Very good explanation. Thank you for the clarification. So okay, let's do the pro forma. Let's go over the monthly. $1,300 gross rent minus taxes, monthly $92, insurance $48, and property management fee of 10%. I believe it's 10%. And then, yes, look, as a primary home buyers, investors, listen closely. A primary home buyers, someone is buying owner-occupied properties, right? Or a first-time home buyers, right? When people buy a home to live, they buy based on the payment, based on the monthly payments, principal and taxes, right? Mm-hmm. And therefore, the interest rate affects a primary owner-occupied buyers. That is their criteria to make this important decision, right, Maureen?
Yes.
Now, as a real estate investor, you do not buy based on interest rate. You buy based on the numerical analysis and the positive cash flow and all the other numerical metrics, which I am sharing with you. You just noticed, right? Even at 5.5% projection interest rate for investor rate on this particular pro forma, and the payment is monthly payment is $979, right? This $979 is part of the debt obligation, is part of under your expenses, right? See, I say it again. The $1,000 mortgage payment you're paying to buy this investment property as an investor is buried inside the expense calculation. Is not a primary driver for your decision making. Your decision making as a risk investor, you have to look at the potential monthly gross rent at 20 to 25% down payment minus all the debt obligations. In this case, the numbers or your mortgage payment $979, right? And your taxes, insurance, property management fee, and what have you, equals your net operating income, okay? And then equal monthly cash flow is a measly $32 monthly net cash flow. You're thinking, oh, wow, the monthly cash flow is so low. No, I'm not gonna buy this. Wrong. I know cash flow is a little bit low. I understand that, but just bear that in mind. So let's go through the subsequent calculation beyond the first year, right? At least, hey, look, at least your rent is covering all your debt obligations. So that's a win, okay? It'll make the deal for you moving forward. Look at all the good stuff. Most investors, not especially newbies, even large experienced investors, they don't even look at the returns from year to year, year 1, year 2, year 3 to year 10 and beyond. Let me briefly share that with you. And Maureen, you and I went over this on our previous presentation a while back, but it bears repeating because this is so important. I know a lot of investors, you don't have the proper software, or some of you are not, are not mathematically inclined, but you don't have to be a math wizard to calculate this kind of numbers, right? So don't fear math. It's just simple calculation of math. But once again, you investors, you have to listen to this presentation more than once, right? The repetition is the mother of all learnings. All right, so therefore, let's look at the year 1 and year 10. Look at the amazing total return you're getting, okay? And the projection I put down is 5% rental increase every year, right? It's just a projection, okay? No one can predict the future, okay? I don't have a crystal ball. And then our assumption, we're making 5% rental increase every year, and then 5% appreciation rate every year. So with this assumption already in place, let's look at from year 1 to year 2, look at the gross rent, right? If you increase gross rent 5%, which is in line with inflation, you see the rental gross rent increases year 1, year 2, year 3, year 4, so forth, and all the way year 10. Then you minus the vacancy losses, potentially 5% vacancy rate per year. Then you have the operating income right here. Now look at the expenses. Yeah, the taxes will increase little by little, just like insurance. That's inflation, cost of living, whatever, those kind of things. So look at expenses. Gross rent minus expenses, right, equal whatever. Then the next category, let's talk about, let's categorize income analysis, right? So you have your rent minus your debt obligations equals net operating income. Then you minus the annual mortgage. By the way, yeah, your mortgage, as Maureen alluded to, is a 30-year fixed rate mortgage, which is amazing strategy, which is a hedge against inflation. We will talk more about that. So your mortgage payment will stay fixed, where everything else is variable expenses, including inflation. Then your cash flow, right, at the end of the first year, nothing to brag about. If you increase your rent 5% year over year for the next 10 years or more, you can see your cash flow will increase little by little, right? So if you stay patient, your cash flow will get better. So don't worry about that, right? So cash flow will create that deal, but the way you make money with real estate is multi-dimensional, and we are talking about it right now, right? Then your renter is gonna pay down your mortgage. So your renter is gonna pay down everything, not just the mortgage every month, right? So if you buy in a good market, a good rental market, good appreciation market, population growth, job growth, whatever, as in this case with the market that Spartan Invest is doing, over time, you're going to achieve your goals. So principal reduction, right? Is it amazing, right? And your renter gonna pay down your mortgage, gonna pay down your little bit of your principal reduction as well over time. See, you see this amazing trend that we're seeing. Then appreciation every year at a mere 5% appreciation. Year 1, your appreciation is already 11,500. But look, okay, at the end of the first year on the previous projection. In fact, let me go back to the previous notes. Look at the numbers. Now, at the end of the first year, 5% appreciation, 5% multiplied by 230,000. So your first year appreciation is around $11,000. Now, because of you using leverage, the power of using a loan, then the $11,000 of at the end of first year appreciation at 5% divided by your total down payment, which is your total investment of 61,000. Guess what? If you look at upper right hand corner, your total return on investment is more than 20%, much higher than the stock market, Bitcoin or crypto or mutual funds or whatever you have. Just at the end of the first year, the total return at the end of the first year is more than 20%. Why? Because you use the power of leverage. When you use loan, when you use financing, your return on investment is higher. No other investment, no other asset class other than real estate, you can do leverage. When you buy a stock, you're buying dollar for dollar. When you buy for crypto, you're buying dollar for dollar. There's no financing, there's no leverage. So hard asset really beats other type of assets on historical basis. Okay, that's a fact. Jack. Right.
That is a fact, Jack. I like it. Said with such enthusiasm and exclamation point at the end of that.
Yeah, there's a movie made by what's his name?
I wouldn't recall, but I know the line. That's a fact, Jack.
Yeah, Bill Murray made that movie, the military movie.
Stripes.
Stripes, great movie, great military comedy, 1991, 1980. Anyway.
We probably lost some of the millennials there, Seewing. You have no idea what we're talking about.
Yeah, I'm not a millennial. I'm a baby boomer. Okay, all right. All right, let's continue with this amazing numerical analysis. I digress. Getting back, okay, your cash flow is higher on an annual basis as you increase your rent, right? And then principal pay down, appreciation. See, every year with 5% appreciation, second year you could get 12 grand of equity appreciation. Third year at 5% growth, 12,679, and then eighth year, $17,000 appreciation that year, right? It's just accumulated, compounding, the compounding effect of owning a real estate hard asset. And then finally, I think I'm done with that. In fact, there's more. My second slideshow, so we're heading into the category of loan analysis, right? Every year, your 230K purchase at the end of the first year increased to 241 at 5% appreciation, second year 253. You see the systematic increase of the market value of your property. Then your loan balance gonna increase year by year, and your poor renter is making you rich, all right? And there are plenty of them around that are begging to rent your place. Is that amazing? They are making renters, tenant are making you rich, all right? I mean, you as a landlord, you're making, you just wow, you're just living the life, right? Your market value of your home systematically increase year by year from year 1 to year 10. Your loan balance decreases. What a great concept. Year to year, then equals your equity. Rising market value, hopefully, over time, decreasing loan balance will give you more equity year by year. At the end of the first year, only $71,000 of equity. But at the year 4th and 5th, look at how much equity you have gained, right? 117,000, 134,000. Then let's look at one of your potential many multiple exit strategies. I call it exit strategies. That's the power, right? When you build a portfolio of real estate, buy more than one rental, hopefully, right? Maureen and I, we encourage people to buy at least 10 properties, right? At least 10 properties in the next few years. Build up that portfolio, 10 properties, 1 to 4 units, for example, mainly 1 unit, single family home, the ideal. And then you just do it in a turnkey way, and then if you own 10 or 20 properties, guess how much time you spend managing your properties every month? 1 hour, maybe?
I'd say, yeah, maybe 1 or 2 hours a month. You're not really doing much other than looking at your statements.
Exactly. That's right. Okay. Anyway, then your loan to value ratio decreases because your rising market value minus, decreasing loan balance, right? See your loan to value, the year 4th and year 6, these are 50%. Guess what? At that time, if you want the ideal way to get more wealth, to accelerate your wealth, is to cash out, refinance the equity from your rental property to buy more rental properties. The year 4 to year 6, at 58% loan to value, you can refinance 20 grand to 30 grand. You can buy 1 or 2 more properties from this one rental by leveraging cash out refinance when the LTV is sufficient, right? So that's how you build your portfolio. You put your initial down payment, and then over time, in the next few years, you can cash out refinance. By the way, when you do cash out refinance, it's a tax-free transaction. right? No tax implications. Another great aspect of owning a hard asset, you don't pay taxes. All right, and then let's look at the final numeric. I know is much more than, I don't want to spend too much time on number crunching. Sometimes it's kind of boring, but this is necessary for you to learn. Okay, I mean, investors need to be re-educated, and this 10-year projection is such a crucial aspect to learn for any investors out there, whether you're experienced or newbie. So the final category for the next few minutes is a sale analysis, right? So that's just the equity you have, right? Market value minus loan balance equal your equity for over the next 10 years. Then if you were to sell your property at some point in time, it's okay to sell your property down the road, right? But invest for the long term. If you, for whatever reason, if you need to sell at the 5th year or the 8th year, this is the potential gross profit, proceeds from the sale before closing costs and all that stuff, right? 113,000, 166,000, it's a nice chunk of money. So you're going to sell your property. If you're going to say you're done with risk investing, you don't want to become a landlord anymore, that's fine. Life happens, right? Whatever goals you have at that time, it's okay to sell and pay your capital gains tax of 20% or whatever the tax bracket at that time. You still have a good net profit after you pay the capital gains tax. If you sell, you still have a nice chunk of money that you earn by owning this investment asset over time. But then again, if you want to continue to be a landlord, you can sell your one or more rental properties at the 5th, 6th, or 7th year and not pay capital gains tax. You can do a 1031 tax deferred exchange, right? Again, I'm not a tax advisor. Maureen's not a tax advisor. You need to consult your tax advisor or your financial advisor to go over your unique situation. I'm just giving you a disclaimer. But you do a 1031, then if you sell one of your investment property and you buy a replacement property, you can sell 1 or 2 single family home rentals, or and you can buy a fourplex, or a commercial unit or something like that, and the profit you make from the selling of the property to trigger the 1031 tax deferred exchange or tax defer. You don't pay taxes as long as you meet the requirement of a 1031 tax deferred exchange. Is a subject for another topic. Many of our investors, Maureen and I, we have helped to do the 1031. So very, 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 very profitable. And one final thing, real estate investing is a generational wealth building. It's a generational wealth building scenario you can pass on to the next generation. Is that if you hold your rental property forever, right, and enjoy all the passive income and tax benefits and cash flow and appreciation, if you hold it forever until you pass, guess what? At the time of death, the asset will have a step up in basis. That means the value of your real estate properties are at the time of death is trigger a market value. So there are no tax consequences for your beneficiaries, right? So if you want to create a legacy for your children and grandchildren, into the next generation, right? The wealth building over time that you achieve at this time will have a legacy transfer for your, for yourself and your loved ones, right? So, and 2 more things, and we should be finished very shortly. And something Maureen talked about, I want you to talk a little bit more about it. The power of the 30-year fixed rate mortgage. I mean, it's just people take it for granted, right? I mean, a fixed rate mortgage as an investor is such a powerful strategy. It's a good debt. To me, it's an 8th wonder of the world. It's the greatest invention in the history of wealth building, and it will change the trajectory of one's financial future. And it's an inflation-induced debt destruction, right? So if you use good debt, if you leverage your investment property with a fixed rate mortgage, do it multiple times by buying multiple rental properties, it will change the legacy of your family's life generationally. So Maureen, let's talk a little bit more about the power of the 30-year fixed rate mortgage and why it's a hedge against inflation.
Yeah, so Seewing, well done, by the way. I love the analytics that you went over, because you really, the last two slides really illustrated the multiple ways that real estate pays you. And if we could just, I'll answer your question. If you could go back one slide. I want to highlight this because I think as investors are looking at and they're evaluating, let's say an investor was in their own little office of their home and they're looking at this spreadsheet, right? All these data points. And a lot of times if you can go see where it says the cash on cash return, right? If you want to kind of move your cursor to the cash on cash return up above the loan, up above the loan analysis right there, right? You see 0.4%, 1.4, 2.5, 3.6.
Right.
So think about the error that an investor would make if they are simply basing their investment decision off of the cash flow only, right? Think about it. If you have to, the way to build wealth, the way that you generate wealth is whatever your capital, whatever vehicle you place your capital, could be real estate, could be commercial real estate, mobile homes, multi-units, crypto, oil and gas, cannabis, I don't care what it is, right? The thing that you have to, as an investor, the way that you build wealth is your rate of return has to beat inflation. It just has to. Because if you've got, let's say you've got $200,000 sitting in an account earning 1% and inflation is 8.5%, the value of your 200,000 is decreasing every single day that you do not get that capital earning above inflation. Okay. Now, when you look at this cash on cash return, or maybe you're the investor that just looks at the dollar and cents. Like, I'm a dollar and cents kind of gal. I want to see how much money is coming in per month, right? But if you were first time looking at a pro forma and you've never bought an investment property before, and this is what you're looking at, you might just go, and you're only looking at year one, right? 0.4, not very exciting, right? Especially if inflation is 8.5%, which I think is underreported. I think it's higher than that. But you see year after year, now this is just the cash on cash return, right? You see year after year that cash on cash return goes from 0.4% past 11%. The same thing with your, let's see, I don't think you have it here on the rent. But when you are looking at making a decision on investing, if you just base your decision on the cash on cash return or just on the cash flow, the monthly cash flow per month, and you exclude, maybe accidentally, you don't really think about what is the appreciation of this asset over my holding period of, X a number of years, 5 to 30. What is the principal pay down benefit from a rate of return perspective over that 5 to 30-year period? What is my depreciation or my tax benefit year after year, for the 5 to 30 years that you're holding the property? That, when you get that big picture and you just get off that one little metric of the cash on cash return, and you look at it globally of what a real estate investing in a piece of property does for you long-term, you and your family long-term, that's when your mind opens up. And that's when you get to, you finally hear the messaging, because I get it. A lot of times you guys could be tuning in and going, oh, they're just trying to sell us properties. No, we're trying to help you understand wealth building principles that will help you and your family get to where you want to go. It's not going to happen in the first 12 months with a rental property. But when you build a portfolio and you hold that portfolio or those numbers, that's number of properties for a period of time, you earn on appreciation of that asset. You earn on the rent increases that increase your cash flow. You earn on the amortization schedule on the principal buy down piece. You earn on the tax benefit that you get every single year. And you earn on the hedge against inflation, because as inflation increases, rents increase and the value of your property increases. I don't know any other asset class that offers that kind of level of protection against inflation.
Unbeknownst to you, Maureen, I'm just segueing into what you just said. Here it is. By the way, Maureen had no idea my slideshow. And it's just, you and I have such a good synergy. What Maureen just said is just such a powerful way to say it. And no other real estate guru out there other than Maureen and myself can give you this kind of perspective around real estate investing. So with that said, what Maureen just said was income property and rental property is the history's most powerful and proven multi-dimensional real estate asset class. All right, let's digest this terminology for a second. I say it again, and Maureen, if this doesn't excite you, you guys out there, Maureen is excited, I'm excited. Just, I want you to ingrain this terminology into your brain if you want to become a serious real estate investor. Let me repeat this again. An income property, a rental property you're purchasing, whether a single family home or duplex or triplex or fourplex, is history's most attractive, most powerful, most proven, and most tax efficient multi-dimensional real estate asset class. Why? Because you're getting a passive income, increasing cash flow over time, right? You get depreciation tax benefit, or your income from your property will be hopefully taxed at a much lower bracket, because all the deduction expenses, your mortgage, your taxes, your insurance, your property management fee, are all a annual tax deduction against your gross income. Plus, you have other aspects of taxes like 1031 tax deferred exchange, or when you pass, your property get a step up in value, so your beneficiary does not pay taxes. You get cost segregation, which we don't even have time to talk about. You get bonus depreciation, acceleration depreciation, which is all kind of great stuff. And then, of course, historical growth appreciation. Over time, your asset will appreciate and all that stuff. And finally, leverage. When you talk about leverage, right? No other asset class will give you that. Leverage gives you a higher return, allow you to put a lot less money to buy an asset, which is worth a lot more money.